Hi there, it's Friday the 9th of November 2018. I'm Steve Towers. Welcome to ITB. Let's get started. Well, there's still no consensus in the EU on the digital services tax. Consensus certainly didn't emerge during the most recent ECOFIN meeting in Brussels on the 6th of November. However, Austria, in the EU presidency seat, still says it's optimistic of achieving consensus at the next ECOFIN meeting on the 4th of December. An interesting concession by France might assist with achieving that consensus. Under the original plan, the EU DST is to commence on the 1st of January 2020, with the OECD to issue its final report in mid-2020. If the OECD report reflects global consensus, then the EU DST can be replaced by the global model. France's proposal is to reverse the order. The EU DST would commence on the 1st of January 2021, but only if the OECD report in mid-2020 shows that global consensus has not been achieved. If global consensus has been achieved, the EU DST would never begin operation. However, France wants an agreement to that effect to be made at the 4th of December ECOFIN meeting. Apart from the issue of alignment with the OECD, Germany has concerns over the proposed scope of the DST. In particular, it wants the sale of user data to be removed from the scope. It's concerned that this could possibly catch German motor vehicle manufacturers which share data. In the UK, the government has launched a public consultation on the detailed design, implementation and administration of the 2% DST, which was announced in last week's budget. Public comments are requested by the 28th of February 2019. For a copy of the consultation document, please go to our website or app. And the number of countries considering the introduction of a DST continues to grow. The latest are Mexico, where a DST bill is being discussed in Congress, and New Zealand, where the government has announced that it is studying the issue. And now for the developments in Asia Pacific. In Australia, the government has announced some changes to the petroleum resource rent tax to reflect changes in Australia's petroleum production, relatively less crude oil and condensate, and relatively more LNG. The changes are proposed to be effective the 1st of July 2019. For a copy of the government's announcement, please go to our website or app. And also in Australia, the government has launched a public consultation in regard to the tax implications of the adoption of a new accounting standard for insurance companies. The accounting standard is AASB 17, which adopts IFRS 17 issued by the International Accounting Standards Board last year. AASB 17 will be effective for annual reporting periods which begin on or after the 1st of January 2021. The government has invited public comments by the 31st of January 2019. For a copy of the consultation document, please go to our website or app. In Malaysia, the government has presented its 2019 budget. Here are the items that caught my eye. In regard to corporate income tax, The tax rate which applies to small and medium enterprises will be reduced from 18% to 17%. There's no change to the standard corporate income tax rate of 24%. The transfer of tax losses within a group will be tightened, and the carry forward of tax losses and undeducted tax depreciation will be limited to 7 years. At present, there is no time limit. There are rate increases for the real property gains tax effective the 1st of January 2019. For a company which makes a disposal after 5 years, the rate will be increased from 5% to 10%. The 6% service tax will apply to inbound digital services, such as downloaded software, music, videos, and digital advertising. For B2B transactions from the 1st of January 2019 and for B2C transactions from the 1st of January 2020. Now, to be clear, this is not a digital services tax like that being considered by the EU and the OECD, which is a surrogate for corporate income tax. The Malaysian service tax is a consumption tax like VAT or GST, and this proposal is in accordance with the global movement to impose such taxes in the destination country. For B2B transactions, the tax will be collected from the resident payer under a reverse charge mechanism. For B2C transactions, the foreign supplier will be required to register, report, collect, and remit the tax. No threshold has been indicated so far in regard to either situation. And the government is proposing to make significant changes to the tax treatment of Labuan entities. Labuan is Malaysia's onshore tax haven. I noted 3 changes in particular. The election to pay a flat tax of 20,000 Malaysian ringgit will be removed. That means that all companies carrying on a Labuan trading activity will be subject to a 3% tax rate on profits. Secondly, substance requirements will be announced. And thirdly, and what is probably the most significant change, there will be a cap on deductions for Malaysian residents which make payments to Labuan entities. In the Philippines, the government is concerned that some of its rhetoric on reducing tax incentives under the Trabajo bill might have gone too far. The Department of Finance has now issued a statement which seeks to reassure foreign investors that are qualified and performing well that they have no reason to be concerned about the bill. For a copy of the statement, please go to our website or app. In Taiwan, you'll remember that the government issued a public ruling in January this year, deeming a Taiwanese source for several types of digital services provided by non-residents with no PE in Taiwan. According to the ruling, a liability for Taiwanese income tax will arise in such situations, and this will be collected either by a withholding tax in a B2B situation or by the filing of a return by the non-resident in a B2C situation. That ruling did not indicate the position where the foreign supplier is resident in a treaty jurisdiction. Well, that has now been remedied. The government has now issued a press release confirming that treaty exemptions can be claimed against this deemed source rule. For a copy of this press release, please go to our website or app. And now for the developments in Europe. In Albania, the government has proposed a number of tax changes to be effective the 1st of January 2019. 2 in particular caught my eye. The dividend withholding tax rate will be reduced from 15% to 8%. and capital gains tax will be applied to disposals of shares in land-rich companies. Companies where the shares derive more than 50% of their value from Albanian immovable property, which is defined to include natural resource rights. In Denmark, the tax authorities have issued for public consultation draft guidance in regard to implementing the 2016 decision of the European Court of Justice in the Masco case. That case concerned a situation where a Danish company, Exco, made an interest-bearing loan to its German subsidiary, Wyco. Under Germany's thin capitalisation rules, Wyco's interest expense was treated as dividends and thus it was non-deductible. However, under the Danish corporate income tax law, Exco's interest income was taxable. Interestingly, the Danish tax treatment of Exco's interest income would have been different if Wyco had been resident in Denmark. In that alternative situation, if the Danish thin cap rules disallowed an interest deduction for Wyco, the corresponding amount of interest income would be tax exempt for Exco. That difference in treatment was claimed by the taxpayer to breach the EU's freedom of establishment, and the European Court of Justice agreed with that claim. And so the draft guidance sets out the proposed situations in which a Danish parent company can claim a tax exemption on interest income derived from EU subsidiaries, in line with the Masco case. The tax authorities have asked for public comments by the 22nd of November. For the link to the consultation website, please go to our website or app. Remember the major frauds concerning dividend withholding tax in Denmark and Germany? Apparently, the two frauds are very similar. The German fraud occurred a number of years before Denmark's. Well, the Danish government has now asked the German government why it didn't alert it so that it could have taken defensive measures. That sounds like a good question. The European Court of Justice has decided a case concerning state aid in the form of an exemption from Italian property tax granted to a church-based school and hostel. What's interesting about this case is that the European Commission had concluded that there was illegal state aid, but that it would be absolutely impossible for the government to recover the aid. And the court action was commenced by two private sector competitors of the church-based school and hostel. The court held that the two private sector companies did have standing to challenge the Commission's decision not to require recovery of the state aid. And the court concluded that that decision was incorrect. For a copy of this case, please go to our website or app. This case reminds me of the recent European General Court decision concerning the Danish government incentives given to the operators of the fixed link bridge between Denmark and Sweden. I discussed this decision in ITB on the 28th of September. In that Danish case, private sector competitors of the bridge, ferry companies, commenced the action, asking that the European Commission's decision in regard to the state aid issues be annulled. The European Court of Justice has decided a case on referral from Portugal. This case concerns Portuguese capital gains tax, which imposes a larger tax burden on non-residents than on residents. The court held that that aspect of the capital gains tax breaches the EU's free movement of capital. For a copy of this case, please go to our website or app. And I have a third case from the European Court of Justice. This case, C&D Foods Acquisition, is a referral from Denmark, and it concerns the claiming of VAT input tax credits for VAT incurred on M&A consultancy services. The consultancy services related to a proposed sale transaction, which was not completed, of shares in a sub-subsidiary, to which the taxpayer company provided management and IT services. The court held that input tax credits are not available to the taxpayer company. For a copy of the decision, please go to our website or app. The EU has made a small change to its blacklist of non-cooperative jurisdictions. Namibia has been moved from the blacklist to the so-called grey list, those jurisdictions which have made commitments to reform their tax policies. So that leaves 5 jurisdictions on the blacklist: American Samoa, Guam, Samoa, Trinidad and Tobago, and the US Virgin Islands. And now to Germany. The Ministry of Finance has issued an interesting decree in regard to Germany's exit tax rules. These rules apply to deem a disposal of assets at market value when the assets are effectively moved out of the German tax net. For example, by the transfer of tax residency of the taxpayer. But the decree clarifies that exit taxation can also occur when the taxpayer does nothing. This is called a passive triggering event. For example, if Germany enters into a new double tax treaty with country X, and that treaty gives to country X taxing rights on gains on assets owned by a German resident, then the entry into the treaty will trigger the exit tax, even though the German resident has not undertaken any transaction. And according to the decree, this exit tax will occur regardless of whether the treaty requires Germany to relieve double taxation by the exemption method or the foreign tax credit method. Very interesting. For a copy of this decree, please go to our website or app. In Italy, the tax authorities have issued a number of items of guidance in regard to VAT. I have 3 for you: VAT treatment of transfer pricing adjustments, VAT treatment of intra-community transfers of goods, and VAT grouping. You can find copies of all 3 at our website or app. Jersey, Guernsey and the Isle of Man have issued a joint paper and draft legislation concerning the substance requirements which will be necessary for resident companies for accounting periods which commence on or after the 1st of January 2019. This initiative is part of the effort for the 3 jurisdictions to move off the EU's grey list of non-cooperative jurisdictions. For a copy of the paper, which in turn provides links to the 3 sets of draft legislation, please go to our website or app. In the Netherlands, the government has announced again that a conditional withholding tax on interest and royalties will be introduced effective in 2021. The withholding tax will apply if the interest or royalties flow to a related party in a low tax jurisdiction, which will be defined to mean a jurisdiction with a statutory income tax rate of less than 7%, or a jurisdiction which is on the EU's black list. For a copy of the letter to Parliament from the State Secretary for Finance, please go to our website or app. In Poland, the government has confirmed that VAT returns will not be required to be filed effective the 1st of January 2019. Instead, all of the relevant VAT data will be obtained from the standard audit file for tax, which will be modified to capture the additional information. In Russia, the government has published in its Gazette a law which provides tax incentives for R&D activities undertaken in Russia's innovation centres. The tax incentives include exemption from the 20% corporate income tax, exemption from the 20% VAT, and significantly reduced social contributions. For a copy of the new law, please go to our website or app. In Spain, the roller coaster continues. I'm talking about the mortgage documentation tax. The story started a few weeks ago when a Supreme Court panel ruled that the tax, which has traditionally been passed on to the borrowers, must be paid by the lending bank. I covered this item in ITB on the 26th of October. Well, this week, a plenary session of the Supreme Court voted by 15 to 13 to overrule the earlier panel. The banks can pass the tax on to the borrowers. At that point, cue the politicians. The Prime Minister stated that the law will be changed to ensure that the banks pay the tax. But remember, he leads a small minority government. In the UK, the government has introduced into Parliament the Finance Bill, which reflects many of the proposals announced in last week's budget. For a copy of the bill and its explanatory notes, please go to our website or app. The most interesting topic in the Finance Bill is called offshore receipts in respect of intangible property. These are the new rules which replace the originally proposed extension of royalty withholding tax. The relevant provisions are contained in Schedule 3 of the bill. Here's a quick summary. Let's start with the operative provision. It applies if a person is not UK resident and is not resident in a full treaty territory, a defined term, and UK-derived amounts, also a defined term, arise to the person. The operative provision charges income tax on the UK-derived amounts which are deemed to be UK-sourced income. The term full treaty territory is defined to mean a territory if the UK has a double tax treaty with that territory and that treaty contains a non-discrimination provision equivalent to Article 24.1 of the OECD Model Treaty. And the term UK-derived amount is defined to mean an amount if A, it is an amount, whether of a revenue or capital nature, in respect of the enjoyment or exercise of rights that constitute any intangible property, and B, the enjoyment or exercise of those rights, or of any rights derived directly or indirectly from those rights, enables, facilitates, or promotes UK sales directly or indirectly. As you can see, the term UK sales is used. That term is itself defined to mean any services, goods, or other property, A, provided in the UK, or B, provided to persons in the UK. Let's put all those elements together in this example. ACO is resident in country A. There's no double tax treaty between the UK and country A, or if there is, the treaty does not contain a provision which is equivalent to Article 24.1 of the OECD Model Treaty. BCO is resident in country B. ACO is the owner of IP, for example, a patent or trademark. ACO licenses that IP to BCO in return for royalties. BCO uses the IP to manufacture goods which it then sells to UKCO, a UK resident company. So, applying these facts to the definitions, BCO's sales of goods to UKCO would be UK sales. That would then cause ACO's royalty income from BCO to be UK-derived amounts. ACO is not UK resident and is not resident in a full treaty territory. Therefore, the operative provision would apply, and thus income tax would be charged on the UK-derived amounts, unless one of the exemptions applies. There are 4 exemptions. Firstly, there's a de minimis exemption if the total value of a person's UK sales in a particular year does not exceed £10 million. For this purpose, there's an aggregation rule in regard to connected persons. Secondly, there's an exemption if all or substantially all of the activity which generates the UK-derived amounts takes place in the territory where the person is resident, country A in that previous example. Thirdly, there's an exemption if the foreign tax suffered in relation to the UK-derived amounts is at least 50% of the UK income tax that would apply under the operative provision. And finally, power is given to the Treasury to provide for further exemptions by regulation. One other point I would note in regard to the UK budget concerns VAT planning by the use of VAT groups, which include branches. This planning has been commonly used in the financial services sector where companies can't claim full input tax credits. In the budget, the government announced that it will be taking a number of measures in regard to such planning. It will expand the definition of bought-in services to ensure that such services, when supplied by overseas branches, are subject to UK VAT. And it will tighten the availability of VAT grouping. And now to Africa. In South Africa, the President has fired the Tax Commissioner. You'll remember that there was scathing criticism of the Commissioner in an interim report recently issued by an inquiry panel. I covered this in ITB on the 19th of October. And now to the Middle East and Central Asia. In Israel, the tax authorities have issued guidance on the transfer pricing aspects of business restructuring by multinationals. The guidance, Circular 15 of 2018, is based on the OECD's transfer pricing guidelines and the 2017 Gateco case. That case concerned an IP startup company which was acquired by Microsoft, and then its business was effectively transferred to other parts of the Microsoft group. A critical issue in the case was the valuation of the business transfer, and whether that value could be inferred from the price which Microsoft paid for the share acquisition. For a copy of the guidance, please go to our website or app. And now to the Americas. In Mexico, the tax authorities have issued regulations which effectively widen the definition of royalties in regard to software payments. This change will have a direct impact on Mexico's double tax treaties. Mexico does not agree with the OECD commentary on the definition of royalties in Article 12. In Mexico's view, payments for the use of software are generally royalties unless the software is standardized. Mexico has made this observation on the OECD commentary. Mexico holds the view that payments relating to software fall within the scope of Article 12, where less than the full rights to software are transferred, either if the payments are in consideration for the right to use a copyright on software for commercial exploitation, except payments for the right to distribute standardized software copies not comprising the right neither to customize nor to reproduce them. or if they relate to software acquired for the business use of the purchaser, when, in this last case, the software is not absolutely standardized, but somehow adapted to the purchaser. Under the recent regulations, the situations in which software is considered to be standardized have been narrowed. And in the US, it looks like a number of proposed regulations will arrive just in time for Thanksgiving. What else were you going to do? 2 sets of proposed regs have recently been submitted for OMB review. The BEAT tax in Section 59A and foreign tax credits, which will include the expense allocation rules relevant to GILTI. And now for this week's treaty developments. We've had 2 treaties signed, 1 protocol enter into force, and 1 mutual agreement signed. In addition, the UK government has published the MLI synthesised text of the New Zealand-UK treaty, as agreed by both countries. For a copy of this text, please go to our website or app. Well, that's the way it is this Friday, the 9th of November 2018. The ITB team will be having a well-earned 1-week break. We'll be back full of life on Friday, the 23rd of November. Until then, I'm Steve Towers. Have a great weekend. And in the US, it looks like a number of proposed regulations will arrive just in time for Thanksgiving. What else were you going to do? Oh, what a turkey.